Today, I'm speaking with Greg Crabtree, the author of Simple Numbers, and more importantly, somebody who can explain accounting, cash flow management in a very simple way, and is also going to share with us his view on what's going on in M&A, but more importantly, for any business owners, what are the top 3 things that you should be thinking about when you're looking at your finances? Enjoy my conversation with Greg. Hello, and welcome to a new episode of the Business of Meaning podcast. Today, I am delighted to speak with what I consider probably the most intelligent and more concrete person that I've ever met when it comes to finance and business. Greg Crabtree is a partner at Carr, and Ingram. Greg, you've been speaking for EO all over the place. More importantly, you had your own business for 33 years before deciding to sell it, if I'm not mistaken.
Yep.
And so I am delighted to speak with you and hopefully get some of your knowledge, some nuggets for people listening. Thank you for taking the time today.
I appreciate you having me and happy to talk to your audience.
Thank you, Greg. So before we dig into this, what I consider one of the Bible for any entrepreneur, the Simple Numbers 2.0, one of your book, but the one that is definitely a reference for me. How did you become an entrepreneur? When did you decide to have your own business?
Well, you start off in a professions world. I grew up on a chicken farm in Alabama, and so that teaches you what you don't want to do for a living. And so my mom would always just tell me, says, it's not if you go to college, it's when you go to college. And she was very, very much a proponent of professional degrees. So my brother was an electrical engineer. I went into accounting. I liked accounting because I went with her one time to get her tax return done, and the accountant worked in an air-conditioned office. And I thought, gee, that sure beats the cotton field and the chicken house. So that was my initial investigation into the field, but it was someone that my mom respected a lot, and so that also had something that was a driver. And like, well, it's nice to be respected. I go off to college, learn, get my degree, start in the profession, and realize that I hate accounting. So, I got news for you. I mean, the stuff that they used to make us do back in the early days, before PCs were widely available. I mean, it was just pretty much drudgery. But fortunately, I got into some bank auditing, got hired by a bank, one of our clients, to be their controller. And that was where I first got my hands on my first PC. And it's like, that was, once I got a hold of a spreadsheet for a person who didn't like accounting, it was the first kernel of going, okay, what can I do with this? And so a lot of the things that are in our spreadsheet models today that we use actually, found its original origin back in that first interactive model that I built for the bank. But, after you run the same company's data over and over again, and this is kind of what I try to tell all my staff to convince them not to go into private industry and stay with us, is that, if you just work on one company's stuff, I mean, you kind of get bored. And that was kind of what I found, is after I kind of fixed the bank's data to where, I mean, we delivered a full board package by noon of the first day of the month. That was, we took it from delivering inaccurate data the day of the board meeting to noon of the first day of the month with every different comparison to budget and forecast and all that. And it just proved that it can be done. So it's like, okay, off to the next problem. And so, but I miss dealing with a client. And so I went into practice on my own, had a couple of partners come and go over the years. And then had worked with a couple of startup businesses. This was back during the late 90s, early 2000s. And one of my clients, he had shifted his office. We'd helped them get their business started, and really good business thinker, moved to Atlanta, and called me up one day and he said, "Hey, you gotta come check out this what was then the YEO, Young Entrepreneurs Organization." Go to one meeting and sign up on the spot, which was kind of crazy for an accountant because I had to drive 4 hours to Atlanta, to be in the meetings. And so I always tell people in EO that said, don't ever give me an excuse that you're too busy to make it to forum, because for 11 years, I didn't miss a forum meeting. And that was driving 4 hours to Atlanta, 4 hours in a forum meeting, 4 hour drive home. but it was the thing that broke me away from this traditional mindset. It forced me to look at my practice as an entrepreneur, not as a practitioner. And when we work with our clients who are practitioners, we have accounting firms as clients, we have law firms, architectural firms, engineering firms, medical practices, dentists, medical specialties, chiropractors, all those. It's the, you got to decide. Or I mean, are you the practitioner or are you a business owner? And it goes back to the classic book that most people have read is, Michael Gerber's E-Myth of, are you a baker or do you own a bakery? And, it forced me to kind of look at it that way. But really being an EO and being in a business group of other entrepreneurs who are trying to get somewhere, and that community, was just and still continues to be invaluable. So I joined in 2001. I made it by 1 month. So we were just over the income limit, and back then we had an age limitation. And if I'd waited 1 month longer, I would have been too old. But the rest is history. But but got to be challenged. The guy that got me into EO, he became the Atlanta chapter president, and the first job he asked me to do. Most people, you're an accountant. What do you think board role they're going to have you do is be treasurer,
Not
right?
membership. There would be treasurer.
No, he would. He asked me to be sponsorship chair.
Oh yeah, of course.
It's like, I'm from Huntsville, Alabama. I don't know anybody in Atlanta other than you. I said, how can I be the sponsorship chair? He says, it'll be a great leadership experience. Sure enough, it was. I mean, probably until the last couple of years, probably for about 15 years, I held the record of the 2 years of the most cash sponsorship received by the chapter in those 2 years. And, and that leads to the next thing. I get on the standing finance committee for the global board. That the next year I'm on the global board from 06 to 09. And that was really where it kind of started the transformation, because it broke me away from the chains of practice, in that I had never traveled between January and April 15th ever during tax season. Our first board meeting was in Tokyo in the last week of March. And so it's like, so I got to be gone a whole week in this middle of probably the busiest part of tax season. And you know what? I left, I went, and, the world didn't end. And, and that just kind of broke it. And, but then really a lot of it though was just giving me some confidence to think that, okay, there is this mindset that I think entrepreneurs face. And, you can either be the biggest fish in a small pond or a little fish in a big pond. I just kind of decided, we kept getting more and more clients outside of our local geography. So when I joined EO in 2001, we had a little over $1 million in revenue. 100% of that revenue was from Huntsville, Alabama. We finished this year, our fiscal year ended with a new firm just for the office that is still us. I mean, we merged, I didn't sell. So I'm still doing the same thing I've always been doing. We'll do about $6.5 million. And 90% of that $6.5 million is not in Huntsville, Alabama.
Wow.
And a lot of it is when you practice locally, you're a local whatever. I'm a local CPA. And yeah, people might respect you and it sounds cool, but they still see you through a local lens. When I leave town, I'm an expert. And so
yeah,
I like being an expert. And and it's like, I don't even try to get business locally, much to the chagrin of my partners at corporate, but it's like, I mean, we have clients in Australia, Canada, Latin America, Southeast Asia, all over the U.S. From coast to coast. And it's really led to be a really unique practice. And I get asked all the time by fellow practitioners, well, how did you end up getting clients, in all those places? It's, well, it's really simple. I mean, you kind of come up with an idea of what you think helps entrepreneurs, give a bunch of talks on it. Then you turn that into your first book, give a few more talks on that, write a second book. And then 15 years later, you're an overnight success.
Yeah, you make it sound so easy and so simple, but out of all the people out there doing what you do, Vern Arnish, who was a guest earlier on the show, actually asked you to write that part for the finances.
Yeah.
How
Yeah.
did that happen?
Well, I mean, I had to give Vern a lot of credit. I mean, he was, I, the first international EO event I went to was 2003 at the EO University in Vancouver. And that's the first time I'd seen Vern. And I was just fascinated. I mean, this guy was just rattling off very valid business concepts, ideas, trends. I mean, it's like, that's pretty cool, and it was extremely useful stuff. And so, we followed Vern, being on the global board. I got to know Vern personally a little bit more. And Vern, much like, the guy, Ron Hollis, who was the guy who got me into EO, the two of them probably were the biggest pushers of writing my first book, because they said, hey, if you think you know something unique, you owe it to the world to write a book. And and I didn't want to, I wasn't trying to write a book to be a marketing prop. I said, I wrote a book for a different purpose. I wrote a book for a purpose of saying, I think I've seen something that everybody needs to know, or multiple things that people need to know. But around this idea of this poor interaction of how accountants serve entrepreneurs. I mean, and really, if you look at it from a bottom line standpoint, the accounting profession does not serve the entrepreneur very well. And there's a handful of them out there that do, but there's not a conceptual framework of how people should think about it.
Right.
And I just felt like that there was a better conceptual framework of how entrepreneurs and accountants should work together that isn't caught up in generally accepted accounting principles or international financial reporting standards and what does the bank want and all those things. It's like, how do you run a successful business from data? And how does that data tell you truth rather than give you, bad information? And so it was just that journey, and continues to be a journey of trying to find that financial truth number that, unfortunately, professional standards doesn't create. I mean, I got news for you. Generally accepted accounting principles does more to hide the truth than it does to illuminate it. So, my peers can criticize me all they want, but it's like, I think I'm right. And it's like, it's just maddening, some of the things that we come up with as profession that seems to do more to make the entrepreneur work for us rather than us work for the entrepreneur. And to me, that's just not right.
Absolutely.
And that's not the way it's supposed to be.
Absolutely. You said earlier something that I think is extremely, extremely important for people that are listening now, and especially business owners in the meetings and event industry. We're excellent at managing logistics, excellent at managing change. And God knows that there's not one project, when I was running project in 20 years, that one was delivered exactly the same way it was planned. There's always something happening.
Right.
But people are not considering themselves as business owners and entrepreneurs. And that is something to your point about being a practitioner or basically being a business owner. Now, other people as well that I've been meeting the last months and the last years are thinking about how to sell their business. And obviously there's the numbers, and there's also the psychological state. So can you just maybe explain a little bit why after 33 years you decide not to sell, but to merge your business? Was it to grow, or just what were the rationale, and how did you do that?
Well, it's no different than every entrepreneur looks at it. And so here's basically the idea. You hit upon this thing of understanding the fact that as I look at hundreds and hundreds of businesses' data sets, I mean, as an accountant, regardless of what your focus is, we see the most intimate details of every business that we work with. And the question is, what are we paying attention to? And over the years, I just became frustrated that, entrepreneurs would do damage to their business, and they would take money out, they would starve it, they would throw money at things with no sense of accountability, or why does that work, or how should it work? And so the second book really came out of this idea, and I've always had it, and you'll see little vestiges of it in the first book, but I really kind of got a framework around it in the 2.0 book, of understanding your business as an investment. That's really where you separate yourself. And I'll make this statement in the first chapter of the first book. You get paid a salary for what you do. You get a return on what you own. Don't confuse the two. And you have to have that mindset as an entrepreneur that it's two different things. And once you separate those two things, now I can start measuring my business as a true investment. And how good is that investment return? And is it willing to accept more investment at the same rate of return? And our data set, and I'll spare you having to read the book, but I think you should. But we believe that any business in a developed economy, U.S., Canada, Australia, it should meet a minimum 50% return on invested capital standard. And that's a pre-tax return, because you got to kind of filter all the tax stuff out of it to get comparability. And so if you look at it and say, how many people would just beat down a path to your door if they could invest in an asset that's going to give you a 50% return? I mean, I don't think anything else that's legal in the marketplace on a consistent year in, year out over a long period of time, it'll do that. And that's just the minimum. The average is, for many business industries, is 75 to 100%. I just came back from a conference with a group of a business group that's in the water damage industry, and I looked at them and I said, listen, you're the way their business model worked. I said, you should be at 75 to 100% return, based on the data sets that we have of our clients in that industry. And it's like, but now there's a point that your business says, I can't take any more money. Growth is purely an executional factor. It's not a money factor. And so many businesses hit that point, and that's where you then harvest the wealth and you build wealth external to the business at that point. But you always want to first reinvest in the business as long as there's growth at that 50% or better return standard in that process. Well, for me personally, it was the same kind of thing, is that we had hit a point where, we actually had more barriers to building the traditional parts of our practice than we had building the consulting part. And so we flipped our practice, and the way we still work today, even as a practice unit of Carr Riggs, is our simple numbers team is we're the lead thing that we attract clients. And so in our case, where my peers in the world of accounting, they do consulting when they're not busy doing something else, we flipped it around and said the most important thing we can do for a client is help them run a successful business. And oh, by the way, if you need tax work, if you need outsourced bookkeeping help, that's fine. We can do that. But we only do those things for the clients that we do the consulting piece with. Now, our other offices in the CRI family, they do it the traditional way, and that's fine for them. But the way our office does it, and we think is the successful way, is I'm looking for a client who wants a planned outcome. And so if you're not willing to do the consulting piece, which we've made very, very affordable and very, very valuable in terms of its output, you're not willing to do that piece, and you're not willing to plan. If you're not willing to plan, you're just going to be a random problem for those other services at the wrong time. And it's very, very intentional in terms of client selection, in terms of saying this is the population of people we want to work with. Now, the advantage of that is, since our practice is all over the U.S. And outside of the U.S., we don't do taxes outside of the U.S. It's only consulting. But we have a big enough market. We're not going to run out of things to do anytime soon.
Absolutely.
Yeah.
So that was because I know in the book later on you say also, there's a chapter, if I'm correct, I remember well, it said know when to decide when to keep or when to sell. So
absolutely. Right.
That's how you decided for yourself. And what can you say about it for those who are wondering right now?
Well, so in the 2.0 book, there is a decision matrix. We call it the replacement return decision. And so, so in my case, the way most professional practices work, now there's a cash price that they'll pay you to go away. Generally, the way it works in the professions world is you merge, and then they buy out your partnership at some point. Well, in my case, I feel like I'm just hitting my prime, so it's like retirement's not in my vocabulary. But if I got run over by a bus somewhere, and there's a substantial entity that's going to pay my wife, a decent sum to keep her in the standard of living she's grown accustomed to. And it's a little bit easier to work out that way. But it is a better value than had I stayed as my own practice it's more unknown as to what that next generation of partners would have been able to afford to pay out. And so, but mine was really not as much of a business value decision as it was access to more resources. And that was, really, kind of the bigger deciding factor. But it did, give me an opportunity, like I said, to create some financial stability. And those, for your EO audience that's listening to this, that's ever heard Warren Rustand speak, Warren's been, I've been very, very fortunate to consider Warren a mentor of mine for quite some time, ever since I met him. One of the things I got to be one of the original faculty members of the first two classes at the EO Leadership Academy when we launched it, years ago.
Yep.
And that was where I got to know Warren. And Warren has always told all of us that he's mentored, which is like a bunch of us, is, creating financial stability for your family is really, really important. And to be quite honest, I mean, there was a lot of my lifetime as an entrepreneur that I flew very close to the sun and lived to tell about it, but wouldn't have been the best thing to do. As I look back on it now, okay, there's a better way to do this. But those are the things that, there was a lot of that kind of went into the decision as well. But realistically, it does allow us to play on a much bigger platform, and access to more resources, in that process. But for everybody else, if you're looking at a sale, and I probably have more clients in the middle of M&A projects right now than I've ever had at one time. This replacement return decision analysis is really a very simple way of doing a calculation to say, from the profit that I'm generating in the business, is the net after-tax proceeds giving me enough money to go create that same net income in a reasonable fashion? Or does it take a 20% return to get it? Well, my rule of thumb is 15% or lower. It should be the replacement return that green lights a sale. If that replacement return takes more than 15% return to get after the after-tax, proceeds are identified, you're probably not getting enough. And I think a lot of times, I will tell you this: there's a lot of shenanigans that goes around how people talk about their sale. There's people that will say, I sold for 7 times EBITDA. Well, did you, or did you? Is it less than that because you had to pay off debt out of that 7 times? And so when you're running a leveraged business, that you didn't get 7 times EBITDA.
Right.
I want to know the real number, that you got. But we are seeing some phenomenal multipliers, and there's a lot of money chasing too few deals right now.
Yeah, and then that's something that I've read the last years, is that in the US, at least, we're facing the next 10 years a tsunami of baby boomers retiring. The second generation doesn't necessarily want to take over or have the capacity to do it. The entrepreneur just doesn't know what to do. And so there's a lot of opportunities coming up. Are you seeing this?
Oh, absolutely. I mean, I can count on one hand how many family businesses we have that plans to pass the business to the next generation.
Wow.
Now, I mean, it's almost non-existent. Now, but here's the thing, when I run the math for them and they understand, because in the first book, in chapter 9, this is a concept that we've used extensively in our practice for people to understand this. I created a very simple valuation technique that has really been golden. It just really gets down to the simplicity of the economics of the business. And I call it the economic value of business, which is 3 times net income plus equity. And the idea being, that's the value that a business can pass to either sale to management or pass as value to the next generation. Well, the reality is it's kind of where you get close to a 4 to 5 times EBITDA number, because if you're fully capitalized, that equity piece is roughly 1 to 2 times net income. And so that's the reason why 4 to 5 times EBITDA is a neutral value, because that's the value that a business can pass. If you buy 100% of it out of its cash flows, it takes about 7 to 12 years in that case for it to buy itself, out of that. And so when you look at that as a transferable value, when somebody's willing to pay you 10 times EBITDA, it doesn't make a lot of sense to pass it to the next generation, because I mean, number one, they might be happy that you pass it to them and they'll end up quickly selling it. and many do in that case. And a lot of times because they realize they're actually not prepared to run it.
To run the business.
A good friend of mine in the automotive industry owns a luxury car dealership. I mean, I'm super impressed with what he's done with he's got 3 kids that plan to take over the business, and they're second generation now. So this would be the third generation running the business. Wow. And they've spent extensive amount of consulting time, sending their kids off to work in other dealerships in other cities to learn the trade in a different environment. And, if you're going to pass it down, it takes a lot of planning to really do it effectively. But a lot of it is very few people actually want to do it. I mean, the kids, I had 4 kids and none of mine went into accounting. So, they probably looked at what I did for a living and I'm not doing that. Yes. So
you mean they don't like the travel, the speaking and everything?
Well, when they were young, I wasn't doing that then, so that came more after they were probably, already set in their mind in terms of what they were wanting to do. So,
well, I also discover over the years that people, they see the top of the iceberg. They don't know what it means. It's not only the travel and everything.
Yeah, they don't see the reality, of what it is. But I think the idea comes down to we're in an interesting environment that has not been this way. And like you said, there's a lot of environmental factors that go into this, and the population shifts, the fact that there's a developed capital market to buy these smaller businesses, to aggregate them into bigger businesses. And you see that in a pretty fertile market. I mean, back in the 80s and 90s, I mean, if you were going to sell, you pretty much, there wasn't a lot of developed private equity groups at that point. And I mean, we've got several private equity groups as clients that we work with their portfolio companies, and I'm seeing those pop up all the time. And part of it is, and this is why I put it in the second book, is, well, they start to realize that, hey, when you're getting 50 to 100% return on invested capital, it might be a pretty good idea to own a bunch of businesses and harvest the profits from that to go invest in other things.
Yeah.
And so what typically most of them end up doing is, if you get into a harvest mode of these highly profitable businesses and you just like running them and you don't want to sell them, then you take that profit that comes off of, and typically most entrepreneurs are going to invest in real estate is kind of where they go next, out of that, because they inherently don't trust the stock market, and, for logical reasons why, but it's just one of those things of going, hey, I don't really care what you choose to do. Just have a strategy of, if you operate a business, just hold it accountable to being profitable and well capitalized and a good return on investment of the capital deployed, and then decide what do you want to do on reinvestment. Is it better to push harder, to grow that business? And for your audience, I'll tell you one thing. I mean, we do not see cash as a challenge to grow. I mean, I would say 90% of our clients, cash isn't their issue to keep them from growing. It's execution. I mean, I mean, we've gotten most of our clients to where they are what we consider cash flow positive on growth. So, and this comes a lot, Vern is just always big on scaling. And the reason why, I kind of call the second book Rules for Smart Scaling. Well, scaling to get bigger and make less money is a bad idea. And there's a ton of people that find that out pretty quickly, because you get into this crucible of cash flow pain. And when you really understand it correctly, and you get our playbook is always built around, I need to get you profitable and cash flow positive for a growth profile, and then you scale. And then it's just a question of, can you go win customers? Are you a geographic limited market? Do you need more product lines? Do you need more segments of your business to grow? Do you need more labor acquisition and leadership to grow? But those are all executional factors. But once you get that model perfected to be profitable and cash flow positive, it's all about execution at that point. And execution is hard.
Very hard. And I realized that looking around me that it's even more difficult today than before the pandemic, I think, to find the right people and the good people that not only understand. There's this thing with EOS, GWC. Do they get it? Do they want it? And do they have the capacity to do it? It is really in the execution that lies all the difference.
And you are finding that there's a bigger shift towards growing your own talent. And yes, that doesn't mean you grow super rapid, but I think more people are finding that hiring that person who has the resume that's been there and done that, they just come with a big price tag and actually they don't perform. And that we're huge. We've seen a lot of instances of success where you take that person who has the raw personality, they know enough to be, a starting point, but they are, but they are really more profitable to develop that person than it is to go spend the extra dollars and get the high price free agent.
Yeah. Thanks, Greg. I can talk for hours with you and listen for hours from you, which I've already done, and looking forward to the next time. Sure. I'd like to end this conversation, if you don't mind, by giving maybe like the top 3 things that people need to do, especially if they've never considered their business from that financial, that simple numbers angle. In terms of best practices, what would be the first 3 things that they need to be doing?
Of late, the last few talks that I've been doing have kind of been centered around the first and foremost, the idea is understanding, your profit engine. How do you generate margin? So let's not talk about bottom line. Let's talk about, revenue minus cost of goods sold is gross margin minus direct labor is contribution margin. And it's really understanding, is everything that you're doing contributing in a positive way to creating $1 of contribution margin? Because I've said frequently that I believe contribution margin is the most important number on your P&L, because that is the thing that is either going to, you want to find where's the maximum throughput of contribution margin that you can get to with this chassis of your operating expenses. And then when is it at a low output to where, okay, this is below sustainability. And so by being able to establish targets of gross margin and contribution margin on a monthly basis and really establish those at the beginning of the month and then work to it throughout the month. There's way too many entrepreneurs that don't look at their data until the month's over and many weeks after the month's over. And they look back, oh, we didn't make money last month. Well, you need to know that as it's happening. And if you don't have good enough data systems, that's really where you need some help. And it's like, and it doesn't have to be perfect, but it's just got to be good enough that the humans that work for you, and let's face it, none of us do anything positive without humans. I mean, labor is still the key to drive profitability and productivity. That you got to get that profitability piece, working. The second piece is then, as you look at your operating expenses of your management structure, is your management labor performing? Are you? And there's 2 errors in management labor. You're either too skinny because you hired people that you expect to manage themselves. Well, that's great, but no matter how good those people are, they still need coordination. And so the effectiveness of management labor is really that once you get that contribution margin, flow, going, that effectiveness of management labor is the next big key to net income. You got some other expenses down there and other operating expenses, but at the end of the day, it's about management labor relative to contribution margin. And then once you get your profit engine identified and figured out, then you flip over to the balance sheet. And my good friend and colleague Alan Miltz and I, we hammer this idea of cash flow. And so one of the things that in the new book I really hammer this idea is understanding this concept of trade capital. Trade capital is essentially taking working capital, is the classic definition, current assets minus current liabilities. Well, I contend that that's a bad number because it contains 2 numbers that should never have been in there. You take out cash and debt and look at what's left. So it's AR, inventory, work in progress, minus accounts payable, deferred revenue. It's the net of those numbers that matter. And as we've looked at this relationship of net income as a percent of revenue versus trade capital as a percentage of revenue on a rolling 12 basis, then you start to see this powerful engine of saying, if I can get trade capital down and profitability up, I then become a cash flow positive generating scaling business.
Mm-hmm.
It is a whole lot easier to grow a business that for every new dollar of revenue you create is a positive dollar of cash. When you have to invest cash to grow, there's a point that the banks just don't want to play ball with it. And then once you run out of bank financing, then you're going into the expensive forms of capital financing, which is fine if that's what the business requires. But I'm telling you, I mean, 90% of the economy does not work that way.
No.
And so, you know, and it's been amazing to me. Once I've identified these numbers and show it to people as to how their data is moving, it's amazing how they become more committed to pushing up profit and bringing down the cash that's invested to turn it over. And once you get those two factors working, you're a juggernaut in business.
It's awesome. And it's, I guess the psychological hurdle at the beginning is to, for entrepreneurs is to sit down to do that, which they've never done before. But when that is in place, it's an amazing management tool.
Well, it does require them to look at the balance sheet, which is that sheet that they never look at, you know, so it is important.
Awesome. Greg, it's been wonderful. Thank you so much for taking the time. How do people get in touch with you?
Best way, greg.crabtree at cricpa.com is one way to do it. Simplenumbers.me is the book website. And then if you know, one of the nice things, you know, as a kid, you know, people always make fun of your name, you know, and all that. But, you know, as an adult, Crabtree is a pretty memorable name. If you just Google Greg Crabtree or Simple Numbers, we're pretty easy to find. There's a lot of the talks I've given are out on YouTube that, you know, we freely allowed people to record anytime I'm speaking that, you know, it's been invaluable. I'm amazed at how many times I'll show up at a conference somewhere to give a talk and people are saying, yeah, I've seen all your stuff on YouTube. And it's like, it's great, you know, and because this is timeless stuff. I mean, that's the nice thing about it is I'm not talking about something that's a trendy topic, you know, of the day. This is something that
absolutely
this is physics. Yeah.
Thank you so much. And I look forward to seeing you soon.
Thanks, Eric. Bye.
Greg, thank you again for taking the time speaking with me. I truly enjoy listening to you. You make things very clear, understandable, and efficient. That's really what I like when it comes to numbers and managing business. Ladies and gentlemen, if you want to connect with me, please go on LinkedIn or join my Facebook group on www.eventbusinessformula.com/group. Thank you.